All right, we're live. Good morning, everybody, and welcome to the second edition of the SVO and Hoge Fenton's Silicon Valley, now focusing on real estate webinar. I'm going to hand it over to Matt Mahood with the SVO to give us an introduction.
All right, good morning, everybody. 10:02, and out of respect of everybody's time, I'd like to go ahead and get started, even though we have people continuing to log on. My name is Matt Mahood. I'm President and CEO of the Silicon Valley organization. And thank you for joining us this morning for our 16th virtual event since we've gone into our shelter-in-place order. The SVO continues to be there for you, your business, and our community. In order to help navigate this very fluid economic climate, our team is continually posting new and most current information, resources, and tools on our COVID-19 business resources page on our website. So if you would, go to www.thesvo.com to find the information you may need. Also, our public policy and advocacy team is working very hard behind the scenes to keep abreast of any new regulations or policies that may affect your business. We're advocating to allow our member businesses and our community to open up in a safe manner that minimizes risk for employees, for their customers, and the general public. So the shelter in place may have limited our capabilities to physically network, but we should certainly still be growing our networks and keeping up with one another. So let's see who's logged on this morning. So feel free to write your name and your company or organization in the chat box. We can keep our connection and our networking momentum going. Feel free to put your name and company affiliation in the chat box. This morning, we've once again teamed up with SVO members Hoge Fenton to bring another panel of trusted real estate advisors to analyze the future of commercial and residential real estate in Silicon Valley. Today, we're adding SVO members J. Paul Company and KW Bay Area Estates to the conversation. Now, before I hand this off, I want to thank SVO community builders and all of our members for their ongoing support and engagement, especially during these times. The support of our members allows us to continue the support and engagement that we need, especially during these times. The support of our members gives us the resources to be a catalyst for business growth, a convener of leaders and influencers, and a champion for a stronger community. We are driven by a fundamental belief that when businesses succeed, our greater communities thrive, and we could not do that without the support of our members. So thank you. And if you are not a member, and we encourage you to learn more about becoming one, if you'd like to do that, talk to myself or Monique. We'd also like to thank those who have made a monetary contribution in support of this morning's webinar. Like many of you and your businesses, the SVO is experiencing financial impacts due to the COVID-19 and our ability to actually meet in person and do many of the regular things that we do to generate revenue. So, but despite those challenges, we're continuing to make our webinars, resources, and our public policy available to the general public during this challenging time. So if you're interested in supporting our efforts to be a convener and a champion for stronger communities, we'd be grateful for your financial contribution of any size. And Monique has put the donation link in the chat box, so feel free to use that. And if you want to learn more about membership, talk to myself or Monique. All right, let's get back down to business today and shift back to today's virtual event. It is my pleasure to hand this off to Stephen Kahn. He's an attorney and shareholder and chair of the real estate practice group at Hoge Fenton, who's going to be moderating this panel. So Stephen, here's part two. It's all yours to
Thank you very much, Matt, and thanks to everybody for joining us today for our second iteration, and an update on the impact of COVID-19 on Silicon Valley real estate. Before I introduce our panelists, a little bit of housekeeping. This meeting is going to be recorded and shared on the Hoge Fenton and SVO websites. To ensure that we have a productive dialogue on Zoom, all the meeting participants will be muted upon their entry. And if you have any questions, please go ahead and write them in the chat box, and the panel will do its very best to answer them in the question and answer portion of this presentation, which will probably be around 10:50 this morning. So I'm Stephen Kahn. I'm a shareholder at Hoge Fenton. I lead our real estate practice along with a great team. We're really honored to be able to present again with the SVO. We're a proud partner of the SVO, and we think it's a great way for us to communicate with the community, with you. Very proud of that. First panelist I'd like to introduce to you all, and I'll go in order and then we'll start our questioning, is Sean Cottle. He's also a lawyer at Hoge Fenton, a shareholder here, one of my trusted advisors and partners. Sean focuses on real estate deals, transactions, planning, and vision for Bay Area clients, particularly in San Jose and Silicon Valley. So that includes purchase, sale, industrial, retail. Sean also handles project advocacy, entitlements, major projects down in the South Bay. You know, if you know Sean, he's a man about town. He's very connected with the San Jose and Silicon Valley real estate communities. Has a special niche focus these days on opportunity zones, 1031 exchanges, ways to leverage and use real estate in constructive and sometimes complicated ways. Sean's a super lawyer. He's got 30 years practice experience. I'm proud to have him on my team. Our next panelist is Walt Stevenson. Walt is the managing director of Cushman and Wakefield in San Jose. He focuses on Silicon Valley commercial real estate. He's brokered over 1.1 billion with a B in transactions for over 7.3 million square feet of space. That's an awful lot. So Walt definitely knows what's going on in the Silicon Valley area. He's got a wide variety of clients, tech companies, higher education, healthcare, commercial retail tenants and owners, publicly traded companies as well. And Walt works with both landlords and tenants, so very happy to have Walt with us today. We've got two new panelists with us today compared to last time. We wanted to add some insight from the residential side and also from the developer side. So our first additional new panelist that we're very happy to have is Mario Ramirez, realtor extraordinaire with KW Silicon Valley Real Estate in San Jose. Mario was born and raised in San Jose. He's got over 30 years experience in residential real estate. He is the person that I go to when I have any residential real estate questions about the market, how to do things right, how to do things professionally. Mario's got an awful lot of excellent certifications. He's a certified residential specialist, a seniors real estate specialist, a certified probate real estate specialist. If you just go online and look up Mario, you'll see what his clients and the people who work with him say. He's fantastic, and we're really happy to have his insight with us today on the panel. And last but certainly not least is Matt Latucci, who is the Chief Investment Officer at J. Paul Company. As I think most of us know, J. Paul is one of the most prominent San Jose, Silicon Valley, and Bay Area real estate developers over the years. Matt has been with the company for nearly 20 years. He manages acquisitions, dispositions, new business opportunities, as well as overseeing all the capital relationships for the company. He's got over 30 years of commercial real estate experience. He's raised over $4 billion in project financing. And prior to joining J. Paul Company, Matt was a senior VP with Key Corp Real Estate and also had positions in San Francisco and New York with Bank of America. Matt sits on the board of the directors for San Diego and Silicon Valley chapters of NIOP, and he was the 2013 chapter president of NIOP. So we are very happy to have this excellent panel with us today. And let's go ahead and get started on the substantive portion. The big picture questions that we hope to answer in the next hour, and what I'll do is I'll go through each of our speakers with an introductory opportunity. Now that we're 2 months into COVID, and whether you call it the shutdown or the lockdown or the shutoff, we want to know from your experience and in your sphere, what's the most significant impact that you've experienced? And then secondarily, what changes have been the most difficult in the industry that you work in? Where has your industry successfully pivoted in the last 2 months? What predictions that you had a few months ago turned out to be true? Which ones didn't actually pan out yet and might be coming? And where do we think things will be in a month or two? So let's go ahead and get started. I'm going to start with Sean Cottle. Sean, please let us know what you think about where we are 2 months in and the most significant impacts you've experienced in your sphere working in commercial real estate from a legal perspective.
Thank you very much, Stephen. And I'd also like to say thank you very much and appreciate what the SVO is doing for our organization as well as for the community. And I hope that everyone is staying safe and being well out there and dealing with this challenging time of ours. So what has happened since we've been sheltered in place? Today is actually the official 8th week that we've all been in place since the order went into effect on March 17th. What I'm seeing and experiencing my sphere is that deals are getting extended out besides closing dates. The transactions, people are choosing to add a couple more months to their deal to see what's going on, and basically just buying some more time. Also, deals are getting retraded on the price, and there are fewer transactions that I'm seeing happening. But at the same time, there are still deals that are taking place. What are the challenges, most difficult challenge in the real estate industry? I think the biggest challenge is that business has just been shut down and people have not been able to go back to their offices, as well as the cancellation of most of the construction projects that occurred by way of the revised shelter-in-place order that came into existence on March 31st. That had a very big impact on the real estate and construction and what projects were allowed to continue being deemed critical infrastructure projects. Where has the industry successfully pivoted? Well, I'll have to give it back to the second revised shelter-in-place order with the reopening of the construction work that occurred. And how many of my predictions turned out coming, where they are now? Well, some development projects, I predicted that some development projects would still be proceeding, and that has been the case. If people have been reading the registry and the Silicon Valley Business Journal, they're well aware of which projects have been continuing to be developed and processed. And one of the main things that people were predicting that has not really changed, to quote Phil Mahoney, the lenders have maintained putting their pencil down. They're still sitting on the sidelines, and I think they're waiting to see how this pandemic is going to impact the real estate community. And where do I think things will be 2 to 3 months from now? Well, I think that commercial and residential leases will continue to be renegotiated and modified. So those are what I've seen since we last convened about a month and a half ago.
All right. Thanks, Sean. That's good insight and a nice lead into talking with Walt Stevenson with Cushman and Wakefield. Walt, Sean mentioned his observations and a few predictions about commercial leasing and commercial activity. Can you give us, please, your insight on what's been going on, what you've observed, and what might be coming?
Yeah, for sure. So I would say now we're 2 months into this. There's been a lot of discussion recently about quarantine fatigue settling in with a lot of people, and I think you're definitely seeing it within our industry. But if anything, it's kind of a good thing to an extent, where there's actually kind of a pulse to the market a little bit of at least email traffic starting to pick up a little bit, inquiries from procuring brokers representing tenants starting to inquire if various spaces are available. They're actually touring activity has been up. I have one later today, and we've seen kind of groups that are actually out there going and touring, obviously with social distancing protocols that are put into place and discussed ahead of time. But I would at least say there's kind of a slow pulse to everything. It's starting to feel like we're moving in the right direction. There's at least finally some kind of light at the end of the tunnel to get things going again.
That's good to hear, and hopefully optimistic news. That leads nicely into some comments from Matt Latucci. Matt, you heard what Walt said about activity starting to pick up again on his end. What's going on from your perspective in the development world and activity in your space?
Well, I think the biggest impact that we felt in our business was the stoppage of construction, which really, we have 1.2 million square feet under development right now in both Sunnyvale in 2 projects and in downtown San Jose. All 3 were kind of at the early stages of development. We lost 2 months of construction time, and that's significant. But the good news is, they're now back as of this week on the job under different protocols, wearing masks and staying apart. And that's significant for the industry, for the economy. So that's been a real benefit to have them back on the job. I agree with Sean and that the debt markets are still somewhat dislocated. They're starting to open up a little bit, which is really good news, because that's really the fuel of our business. We really did see pencils down from most of the money center banks the first month of this crisis, as they were dealing with PPP requests, asset management, workouts, that kind of thing. They're slowly starting to look at new transactions. I think the regional banks were more in the market consistently, but again, they're not able to do some of the larger transactions. Life companies are still financing deals, although at higher spreads and tighter underwriting. The CMBS business came to a grinding halt. That was a big provider of capital for our businesses. And the good news, again, is that's starting to open up again. There were a couple of large issuances of existing CMBS paper this week and last week that were well received in the market. And spreads that had widened 300 or 400 basis points from pre-COVID are now back, not quite to where they were, but close. And that's really good. Predictions, as far as what I predicted 2 months ago, I predicted that Peloton stock would go through the roof. And I was right. Unfortunately, I didn't buy any. Tough to say where we'll be in a couple of months. I think, although things are starting to pick up a little bit, and that's good news. The curve is flattening, and businesses are starting to prepare to open over the next weeks and coming months, which is great news. But there's still a lot of unknowns out there, and a lot of lack of clarity in what things will look like. We've been very fortunate. 95% of our portfolio of about 13 million square feet is in office, and most of it's all leased to credit tenants on long-term leases. So our collections were pretty good the last 2 months. We have a very small retail portfolio, a small piece of our cash flow, and obviously that was hit pretty hard. A little bit of a multifamily exposure. That was actually, collections were pretty good. So we're relatively in a pretty good place right now.
Okay, good comments. Thank you, Matt. That lays a good foundation for what we're seeing happening out in the world. So what I've heard from Matt and from Walt is a little bit of quarantine fatigue. People are starting to go out into the world again. Things are starting to start up. I think that affects the psychology of folks, and psychology plays a big role, I think, in the residential market as well. So I want to turn it over to Mario now and have Mario tell us about, after 2 months, are people buying, selling, venturing out? Are they interested in residential real estate? What's happening?
And those are some good questions. First, good morning. And as Walt stated in the last webinar, there's still plenty of uncertainties in the marketplace. And like Sean, I too am cautiously optimistic. Prior to the pandemic, the housing market in Santa Clara County was strong. Inventory was low, demand was high, and interest rates were nearing all-time lows. During this crisis in California, residential real estate was deemed essential business. The market response to the pandemic has been a decline in sales activity. This should be the case for at least the next couple months. Even though most professions were locked down during the shelter in place, lenders were lending, appraisers were appraising, title companies were insuring, and the county recorder was recording deeds. Since the shelter in place order went into effect in March, there's been about 1,300 plus sales of condos, townhomes, and single family homes in Santa Clara County. Of those 1,300 plus sales, 90% were under 2 million. Only vacant homes were available to be seen, and as of May, we can now show occupied homes, adhering to the CDC and the SIP guidelines. We've seen a decrease in transactions falling through as we progress through this crisis. I had one where the buyers had removed all contingencies, but no longer qualified under the lender's new requirements. The lender no longer was funding bank statement loans due to the uncertainty in the economy. The earnest money deposit is currently in dispute. Fortunately, we were able to go into contract with another buyer. Currently in Santa Clara County, there's 1,400 listings. That's single family, condos, and townhomes. A quick snapshot of single family in Santa Clara County. The average price in April was $1.6 million, down 4% from March. The number of sales in April was 550, down 9% from March. Active listings in April was 840, up 26% from March. Days on market in April was 16 days, down 21% from March. Days of inventory in April was 44 days, up 34% from March. The numbers indicate that it's still a seller's market. However, with the increase of inventory over the next couple months, buyers will have more options than they've had in some time. Now, you might be asking yourself, how are buyers going to find a home when they're not supposed to be, how are buyers going to find a home when they're supposed to be staying at home? How can sellers expect to find a serious buyer when people are reluctant to go outside? Well, technology is bridging the gap through this crisis. We're meeting clients through virtual WebEx, FaceTime, Zoom, Hangouts. We're providing buyers with 3D virtual tours, virtual staging, and most of the paperwork can be handled electronically online through document signing. The legal exposure during this pandemic is greater than ever. So as Sean mentioned in the last webinar, it's more important than ever to increase the lines of communication with all parties. This is the new reality. So since COVID-19, homeownership is a greater priority than ever before. Are you happy where you're sheltering in place? If we harness this virus, by the end of the year, pricing should remain stable through 2021. The real question will be, are we changing our priorities towards real estate? Vacation homes, high density to rural, investment in multifamily properties? Will people forget the labor pains of COVID-19 or take action and prepare for the next pandemic? This will not be the last. Stephen, I'm here to answer other questions when you're ready.
Great. Thank you, Mario. Those are good perspective on what you've been seeing so far. Follow-up question for you. Are you starting to see buyers start to ask for what's called the COVID discount? I've seen some media floating around that people are expecting a discount now that we're in the COVID age in the residential space. Different appetites in different markets. What about around here?
Definitely. In the beginning, I was seeing we were seeing a lot of discounting. People were panicking. And so they weren't quite sure what was going to happen next. There's a stat right now that says that 8 out of 10 buyers believe that they can negotiate a lower price. However, on the flip side, only 3 out of 10 sellers believe their properties have decreased in value.
So it sounds like there's still potentially a disconnect that needs to work itself out through the market. That's okay, but good information for our audience to hear. I want to turn it back to Walt Stevenson, kind of with the same questions. Now that we're 2 months in, are you experiencing the COVID discount ask in the commercial space yet?
Oh, absolutely. And I think it kind of takes a couple of different forms depending on where the deal was within the kind of transaction life cycle. For deals that were already negotiated and were maybe in leases and kind of well into lease review comments at that point, or reviewing a PSA, there definitely have been some retrades on some aspects of it to kind of be able to help go and get a deal done. For deals that were just starting or in negotiations, there's definitely been some significant retrades, or at least attempts for significant retrades in deals. I have heard kind of a consistent number of maybe even 5 to 10% in terms of rental rates from where things were kind of agreed or thought a deal would end up to where it's ending up at the very end. There may be on the leasing front some additional concessions, whether it's a month or two of additional free rent, or maybe some flexible spending with a TI allowance to kind of allow maybe some of those costs to help with like social distancing protocols within an office, or cabling expenses, which are typically not offered there by the landlord. So there's been some of that. There have definitely been plenty of proposals that have come through that are not based on market standards or facts and are simply just extremely opportunistic. And I think some of those are definitely not getting responded to because they're just kind of so out of whack with where market is. I mean, there's no doubt it's kind of an uncertain time. But the floor hasn't fallen out yet, anything like that. So deals are still getting done. I would say for the most part, for a lot of tenants who were out in the market, there's still that certainty out of there. So a lot of them are just on hold and just kind of waiting to see how this all shakes out.
You mentioned that there are some opportunistic folks out there. People are trying to get deals done, maybe take advantage of the situation. So that brings to mind a two-part question, both first for Matt Latucci and then for Sean to follow up. Matt, in your development space, are you seeing opportunities arise, new opportunities that you didn't see before? How is it affecting the plays that J. Paul is making and has been making? We've seen news reports about J. Paul continuing to move forward with opportunities. And then once I have those comments from you, I'd like Sean to weigh in on, now that people are getting back to work, how do they do that? What are the legal ramifications of job sites starting up, construction starting up, office space being rebuilt? So go ahead, Matt, please.
Well, Steve, I think it's still early. We haven't seen a flood of distress yet. I think that will come as fundamentals continue to deteriorate in some markets, and with some undercapitalized investors and developers. We closed a transaction that you might have read about with Wells Fargo buying their building at the City View block, but that was something that was well underway. Probably for the last 18 months. So that was really just executing on something that was already in process and was integral to our future development. So that certainly wasn't a distressed sale or something that came due to COVID. We've gotten some phone calls from some brokers around the country showing us some opportunities. We're kind of sitting tight here. We have a pretty big cash balance, liquidity trove that we can use to pick off some distressed deals if the opportunity is right. I think we'll have to wait and see how it plays out over the next 6 to 12 months, because there will be opportunity. There's also a lot of rescue capital, a lot of equity capital sitting on the sidelines, kind of ready to pounce. So there'll be competition. But there clearly will be opportunities. They really haven't surfaced yet, but I'm sure they will.
Well, that's exciting to hear. We'll look forward and see if they come up, and wait for news for the next J. Paul project or acquisition. It's exciting times in San Jose in particular.
Mm-hmm.
So Sean, following up on Matt's comments,
Sure.
We're getting back to work. How do folks actually do that properly? How do they interpret these orders?
Well, Stephen, let me just give a brief update or recap. I don't know how many people listening in on the webinar knew about the impact that the April 29th revised SIP order had in the 6 counties and the city of Berkeley. So as of Monday, May 4th, a week ago, the construction projects could be up and running again, so long as the construction companies and the property owners followed through with the small business or small construction project safety protocols, or the large construction project safety calls protocols that are called out in the appendixes to the revised shelter-in-place orders. So the construction companies have to implement different things depending upon the size of the project. If it's small, there's less formality, but they still have to do social distancing. If it's larger, they have to have a safety compliance officer as well as a third-party inspector coming out on a weekly basis. So the main requirements are to get the get the workers onto the job site safely, have them socially distance themselves, except there is a caveat that says except as strictly necessary to carry out a task associated with the construction project. So there is an exception to the 6 feet social distancing. There has to be the PPE, the personal protection equipment has to be on site. They have to be checked in. So there's a lot of protocol that is in place. And I've spoken to many of our clients as well as people in the industry, and they're implementing these protocols, trying to get back to work. And that will be in place until at least May 31st, when either the revised SIP order is repealed or revised once again. So people are going back to work. It's a good thing because Matt and his company will be able to restart that construction project on the corner of the Almaden and Park, as well as all the others, Bayview Developments project at Miro across from City Hall. So I expect to see those cranes operating again and people getting back onto the job site as quickly as possible.
Let me just follow up with Sean. So our 3 projects have started again under all these new regulations and protocols, and the cities are out enforcing this stuff. We actually had one of our 3 projects shut down again for 2 days because there were 2 workers without masks who were 5 feet apart instead of 6 feet apart, and the project was shut down. So the cities are monitoring this. There's a rule about no sharing of food. And one of the workers brought a couple of dozen donuts for his compatriots on the job one morning. While the inspector was there, he was told he couldn't give them out. He had to eat them all himself. So I guess that's another health issue too. But the cities are out there monitoring this stuff, at least here in the first week.
Unintended consequences of the shutdown. You have to eat a whole dozen donuts. That's not such a bad thing considering the circumstances. Good comments, Matt. Thanks for chiming in on that. One more follow-up. What's been your experience working with municipalities in general over the last 2 months, not just from an enforcement standpoint, but getting projects reviewed, getting plans submitted? Are they eager? Are they cautious?
Well, I think there was obviously some disruption early on in, cities had to get used to not meeting in person and doing this kind of thing. And I think most of them have pivoted pretty well, and, where they've managed to, review applications and continue the process. So, there was a delay early on, but I think most of the municipalities have done a pretty good job of working virtually and with this kind of technology and pushing things through. Again, it's still early on. I know the city of San Jose has done a good job of working remotely. And it's not just, obviously, it's not just entitlements, but it's also inspections and things like that. And I think there was some disruption in that, but I think they've kind of figured it out and how to get people out on site and keep things moving. So after some initial fits and starts, I think the cities have done a pretty good job in pivoting and working with us to get things done.
So on balance, a pretty good experience. That's good to hear. I want to turn it back to Walt, and then after Walt to Mario. So now that we're 2 months in, we've heard about restarting projects and developments. Walt, have plans for changing how space is used materialized? Has it crystallized what it's going to look like, both in terms of how much square footage people want, where they're going to put their stuff? I saw a news article yesterday with the proposed new office layout, and it's just dots very far apart from each other where people are going to be working and dead space in between. That seems like a sea change from where we were a year ago, where people were trying to pack everything in.
Yeah, there's no doubt that it's changed. And I would say every executive to office manager is certainly rethinking how their office is going to look and fit and feel when they go back. But I will say this, I think everyone's really looking at it two different ways. Is you've got on one end the people that have realized that the technology that's out there for telecommuting and working from home, frankly, is really good because, telecommuting's been around for a very long time. So there are definitely some people that working from home, it works for them and the technology is there to do it. So I think employees are certainly going to have a lot more flexibility to go and do that. On the flip side of this is I think when tenants are looking at their spaces going forward for any relocation where they actually have the ability to start from scratch, they're absolutely kind of looking at increasing that overall average square foot per employee. The days of the benching systems and seeing hypothetical plans with benching systems, I think, are completely gone. I mean, having a 100 to 125 square foot per person ratio is just not going to work. I think you're going to be seeing these ratios as an average, probably, at least 200, if not 250 square feet per person, and trending upwards. I've talked with some companies now looking at, the corporate standard is going to be trending towards closer to 300 square foot per person. So, there's a wide disparity there. And I think flexibility is going to be the biggest thing. So kind of creating these workplaces that allow people to come in, allow them to be socially distanced. But then I think there's still going to be those protocols in place to allow people to work from home, where there's a lot of uncertainty about this, where if there's some outbreak at a kid's school and that school has to be closed, they have to be able to provide that parent with the flexibility of then working from home and then keeping them at home. So I think a lot of these aspects are going to change from that standpoint. We even had kind of our initial call this morning of how things will kind of start to look as we come back into the office. And I think it's going to be on probably no more than 25% of our floor there at any given time. And that's really just going to be completely based on where do you sit in the office. So almost every other cube would have someone in it. And that's also if you are comfortable going back and want to go back into the office. Some people would probably rather stay at home or prefer it, where there are others like myself with 3 small children here at the house. I can't wait to get back into the office. So I just think it's going to be a little different, but absolutely every tenant is reevaluating how their space is and starting to evaluate that now and start to look at it.
Thanks, Walt. I'm not surprised to hear that because I have clients who are dealing with these questions, and even we're answering those questions internally at our firm. It's something we're all thinking about. So I heard a lot of the word home in your answers, and so I want to turn it back to Mario with these questions. People are going to be working from home a lot more now. How do this expectation change their plans for future planning for their home? Are they looking for homes with offices, homes in certain locations because they can commute, or they might have more ability to drive at odd hours? Are they looking for homes with second units in the back so that they can be separated from their children during the day when they're working? How is this changing with the expectation in the residential real estate market?
Well, that was spot on. It's true. People are going to be looking for homes that, since we've been sheltered in place, our home has either gotten pretty small and we need additional space. So a dedicated office in the house is good for people that are going to be working from home. I see ADUs, even though there's, a yin and a yang to ADUs as far as the impact in a neighborhood. They're important because the housing crunch is so huge in Santa Clara County. As far as people working remotely, more rural areas, I see that becoming a trend because it just depends when rural living eclipses high density living. Do you want to be in an environment that has, 100, 200 people in it, and going up the elevator with, a dozen people. There's a lot of things. One of the things about long distance commuting and telecommuting is the speed, the internet speed. And if you have access to internet speed, that's a possibility, and it can be done sooner than later. If you don't have the internet speed, people are a little reluctant to move out there, because the bottom line is you're going to have to be able to still be able to communicate.
Thanks, Mario. You're absolutely right about those considerations. Our guests have probably noticed that I might be in an office today, and I am, and that is because of internet speed. Working from home can be challenging at times, and it's a little spotty, so I wanted to make sure that I've got a good connection for this webinar. It'll come up, so we might start seeing the question on a disclosure form or a question from buyers. What kind of internet speed have you been experiencing, and what can you tell us about it? It'll be interesting how that moves forward. Thank you for those comments. So I want to turn it back to Sean and have Sean hopefully educate us a little bit about what are the tough legal issues we've been seeing come up during this COVID shutdown in the real estate space. 2 months ago, we were predicting what it would be, but now that we've got 2 months of data and information, how are people using legal issues or responding to legal issues with negotiation, or hopefully working together, or maybe not?
Those are great questions, Stephen, and looking at the questions that are appearing on the chat. Let me just, first of all, start off by addressing the moratorium on evictions, be it residential or commercial. Many of us know that the county of Santa Clara adopted an ordinance that said that landlords cannot evict a tenant, be they residential or a small commercial organization, because of the pandemic and their inability to pay their rent. And some of the statistics that I have heard recently, going into today, I heard that locally, on average, there's only been about a 10% drop off on people not paying their rent on a residential basis. I read an article in Mercury News this morning that said that nationwide, on average, the inability for people to pay rent on residential units is down 20%. And I think that as this pandemic continues and the shelter-in-place orders continue to go forward, that may rise. So from a standpoint of landlords, wanting to deal with the rent issues, there's also the rent deferment in Santa Clara County. People can defer their rent so long as they document the reason why they are unable to pay their rent, be it commercial or be it residential. And again, let me qualify that commercial aspect by saying it has to be a small business, and you have to look to the United States Small Business Administration's guidelines that are contained in the Code of Federal Regulations as to whether or not your business qualifies as a small business, depending upon the average annual receipts or the average number of employees that you have in your small business. So rent deferment in Santa Clara County will be deferred for 120 days once the ordinance ends. So right now, hypothetically, let's say the ordinance ends as it's scheduled to expire on May 31st. People have an additional 120 days in Santa Clara County. If you're in San Mateo, I saw their ordinance has 180 days rent deferment. So again, speaking about Santa Clara, if you're in Santa Clara, the renter can defer their rent payment until September 28th, and they will not incur any late fees or interest. So those are the issues relating to moratoriums on rent eviction as well as the rent deferment. But other things that I see coming down the line from a legal standpoint are the fact that people are going to try to renegotiate their leases. I've got a client that I know of right now. They are a commercial property management company, and I just spoke to him last week and learned that his portfolio, so in his company, he's got various co-workers, but his portfolio alone, since the pandemic began and since the shelter-in-place order took effect on March 17th, he has seen a personal renegotiations of lease terms of over 53% of his portfolio. So 53% of his commercial tenants have approached him or have made the approach to him or his property owner to renegotiate and to do a blend extend or any other combination that they could come up with to address the issue of paying rent moving forward. So lease negotiations, as well as the things that I've previously mentioned about whether deals will continue to be going forward or retraded, are primarily the legal issues that I see going forward.
Thanks, Sean. I've experienced that as well, and you make some good points about the key items here, which are documentation, information to prove the legitimacy of any inability to pay. So can you explain why you're not requesting a deferment or can't pay? And then communication between landlords and tenants and property owners and lenders, so that everybody recognizes we're all kind of in the same boat right now, and there's an opportunity to work together if it's possible. I want to turn it back to Matt Latucci and follow up with questions about how well are you working together with the folks involved in your project? So specifically, from an underwriting standpoint, has your perspective changed now that there may be a difference in cash flow going forward? And then incorporating the changes that you have to make on projects, is there an additional cost to incorporate like safety protocols, schedule changes on these projects, and is it having any material effect in your projections for the development side?
Well, Stephen, let's start with the development side, the projects we have underway. I think in the short term, there will be an additional cost just in retooling and restarting a project. There are costs, the general conditions that go up. There are costs in the protocol. Projects are going to take longer, and there's a cost to that. Whether this has a long-term impact on the cost of construction, it's tough to say. It really depends on labor, competition for that labor, material and commodity costs. And I think there's probably downward pressure on both of those in the more medium to longer term. There'll be projects that are on the docket that are planned that probably won't get built now, and we'll be able to capture some of that excess labor. But we're looking, that's 18 to 24 months out. But clearly, initially there'll be an increase to construction costs and project costs. If you haven't gotten your loans in place, if you can get one, those will be more expensive most likely and more conservatively underwritten. When we're looking at doing sensitivities on our future cash flow for the stuff that's not leased, we are probably moving rents down between 10 and 20%, really just to do some sensitivity analysis. And again, moving leverage down from maybe 75% to 55 to 60% to see how a project works and what the returns are, and not putting any rent bumps in for 5 to 7 years, really just again to see how projects will look. But again, it's all speculative. It's really, really hard to tell. We seem to still have interest in our projects. From a leasing perspective, we're also, in some cases, 24 to 42 months out from delivering. So hopefully we'll be well out of this by the time we're ready to put people in seats. But there also is some additional cost in kind of refiguring and looking at refiguring things like HVA systems and filtration systems. None of that stuff has been decided yet. Typically, we're building core and shell, and the tenants will be building out their space and their TI. So most of the core and shell stuff has not necessarily changed yet. But tough to tell. There's going to be changes, and I'm not sure we have clarity in everything yet.
Thanks for that, Matt. You mentioned how some of this is still speculative, and it's 10:50, so I'm going to turn to some of the questions we've been getting. One question I've seen a few times is, what is the projection or speculation on the Google project and the Diridon project. People want to know, is this affecting it at all, affecting the timeline? I saw BART changed its map to add San Jose stations a few days ago, so people are hoping.
Well, what I've seen in the in press is that the planning for the Google Village over on the western side of downtown has been put off until Q1 at the earliest, maybe Q2 of 2021. So the Google Village development project working its way through the city of San Jose has been delayed. They were hoping that they would have that through review or preliminary review this year, but it's been bounced over to the next year.
In my sense is this is an important long-term initiative for them. And, it might be pushed out a year or two, but I think it's still going to happen. And it's again, hard to predict, but I think this is something that's an important piece of property for them and an initiative for them.
Another question we're getting is, how is the shelter in place and the timing changes affecting opportunity zone projects, given the criteria for when you need to do certain things? Sean, can you follow up on that, please, and let our folks know about that?
Sure, I'll take a stab at that. One of the things that the IRS and the Treasury did when this COVID-19 pandemic hit was they said that those who had experienced capital gains between October and April could delay their deployment into an opportunity fund. So I believe if you had to place money within an opportunity fund within 180 days, that deadline has now been extended out to July 21st, I believe is the date. I'd have to check it to make sure exactly. But in terms of the other components of the fund, in terms of the December 31st, 2026 deadline for deferring your capital gains tax until that date, there has not been any additional adjustments long-term that I've seen in the program.
Thanks for that, Sean. Several questions have come in asking about the future of residential real estate, Mario. People are asking, will I be able to afford a home in the future? Will I have a job? Will prices change? And I know that you can't predict the future, but I think folks are wondering if you've seen any trends in where the pricing is going to go, not just in the immediate short term, but longer term, if you see anything changing with that based on what we've experienced in the last few months.
Well, good question. And I don't have a crystal ball, but the wild card here is the virus. And if we can harness the virus, I see a market that's going to be somewhat stable. We're not going to see double-digit appreciation anytime soon, but we were on a run for about 8 years. So our market was giving back a little bit, but I see if we can control, if we can get together as a society and as a country, and we can get the medicines and the therapeutics and the testing and ultimately the vaccine, I think that we'll get through this, and I think the market will be stable moving forward. Is it a good time to buy? Well, interest rates are phenomenally low. Rents are still relatively high, and this is the time as far as being able to get as far as buyers having more opportunities within the next 6 months to a year. I think they're going to have more opportunities than they've had in the last 4 or 5 years, and so the timing could be good because ultimately, long term, residential real estate is a great investment.
Thanks, Mario. That's a good answer and a good segue into our last question for everybody on the panel now that we've got a few minutes left. And that is this: what do you think will be the strongest real estate classes to come out of the COVID crisis? We've got some data, we've got some info. Any predictions that each of you all have? Except Mario, I already know your answer that things will continue to look good, and there may be opportunities. I'll start with Walt. Walt, what are your thoughts on that?
I think right now, probably arguably the strongest going into this crisis, really was industrial. When you look at where vacancy was, by the end of our quarter ended there in March, and I think vacancy across the valley was just over 4%. And in some markets, it's effectively zero. I think as you look at what the shelter in place has done is increase the need for supply chain as well as e-commerce, that people likely will continue to use a lot of that. And so I really think kind of going forward, both locally here within Santa Clara County and the Bay Area and even kind of, the West Coast as a whole, I think you'll continue to see industrial probably be the strongest performing asset class.
Thanks, Walt. Over to Matt. What do you think?
Well, clearly industrial, and especially any industrial that's related to e-commerce. For every $1,000 in e-commerce sales, I think it generates a need for 1.2 million square feet of warehouse space. I think some of the smaller, older flex industrial that's dependent on smaller businesses might see a little softness, but certainly the large, modern, high cube industrial is going to remain really tight. That and bioscience space, lab space, biotech, those deals are still being done at a pretty accelerated pace. That's going to be strong. Office probably somewhere in the middle. It's really too early to tell. I think some of the increased space needs will offset some of the layoffs and some of the recession issues that we have, and some of the stay-at-home issues that we have. And it's too early to tell how occupancy and vacancy will sort itself out over the long term. It's going to be kind of a market by market. And we're certainly in one of the better markets, and a tech-related market. And I think that bodes well for the Silicon Valley. Obviously, retail is going to be hurt pretty badly. Hotels, there are going to be some hotels that never open again. And there's some malls that are going to lose their department store anchors forever. And those two segments are going to change forever, or at least in the short term. But again, I think multifamily is going to be relatively strong. So it's those asset classes that Walt discussed earlier.
Good insight on that. Finish it up with Sean. Sean, any more comments on that one?
Well, the only question I have, and if there is one sector that I think we need to watch closely, is the co-living environment. Given all this, what's going on with the COVID-19 and people requiring to shelter in place and having that dynamics, I think the developers, the planners, the municipalities, the jurisdictions are going to have to reevaluate or recommit to the co-living concept. So stay tuned for that one.
Indeed, stay tuned for that. And with that, we've reached 11 o'clock. So I want to thank everybody for joining us this morning. I hope that this was helpful and informative. Thank you to our panelists, Sean Caudle with Hoge Fenton, Mario Ramirez with Silicon Valley Keller Williams Real Estate, Matt Latucci with J. Paul Company, and Walt Stevenson with Cushman and Wakefield. And finally, big thank you to the SVO and Matt Mayhood for allowing us to have this presentation and speak to the community. Thanks, everybody. And Matt, I don't know if you have any final words that you want to add here.
Just want to thank all of our panelists. Thank you, Stephen, Sean, Mario, Matt, and Walt. Really appreciate you guys spending time with us again this morning. To our SVO members and community partners, thank you for tuning in this morning. Please continue to monitor our website for the latest COVID-19 resources and events that we're producing to keep you informed. Let's continue to maintain our physical. I love it, Walt. You got a visitor there.
I tried. I mean, I kept her downstairs until 11 o'clock, and then like clockwork, the gate came ripped off. So
I love it.
At least say hi. You're talking about 200 or 300 people. So.
Awesome. I love Zoom. Let's maintain our physical distance, wear our face masks, use some common sense. Let's get our economy back open, and we will all be stronger and better in the future. Thank you. Take care. Stay healthy. Be prosperous. Bye.